it's obviously been a big year for markets, aggressive bear market, aggressive sort of bull bounce. And then back into June, we put out some work saying that we thought markets would effectively sort of trend sideways and at times aggressively. And that's sort of the kangaroo analogy. And the reason for that is that you have some very powerful sort of downside risks, of which COVID heads the list, but you also have political risk here in the UK, also in the US with the election. You have geopolitical risks, you have credit risks, but then you have this historic support from central bank liquidity, from what I call QE+, which is a sort of fiscal and monetary sort of combined support mechanisms. You have sort of vaccine hopes coming through. And also, let's not forget, we do have a pathway to recovery, albeit one with risk. So markets are kind of trapped in the middle and kangarooing along until we have this decisive break in either direction.
When it comes to the sell-off that we saw kick off yesterday, it was somewhat surprising given you speak to analysts, you speak to investors, and everyone seemed to be preparing for a rise in cases as we headed into autumn and further restrictions. And that seems to be exactly what's happening now. So why has it triggered the sell-off that it has?
I think it's still a very fragile market. Sentiment generally is has recovered very, very strongly, and on some measures looks very high. But investors are also very, very nervous. It's very hard to put significant weight on the future. If all investors heavily backed, our base case, which is a shift back to synchronized global growth in 21. I think we would have seen much more aggressive moves in markets and much more aggressive rotation from defensive to cyclicals. We've seen some of that, but I would have expected more had more of the market adopted that stance. So I've often described it as this sort of T+0 world where we're living real time, and markets appear to, sometimes violently, as we saw yesterday, price in real time a new mini consensus. And yesterday clearly was a big day for the markets focusing on second wave risks again.
Let us talk about technology shares, because you're comparing the situation now to 1999. So my question is, when do you think will the party be over this time?
Yeah, I mean, the late 90s was an explosive period for markets led by TMT back then. It was a slightly broader group, especially in Europe. A lot of investors are sort of drawing analogies with that period, and there are lots of similarities. There are also some big differences, and the research that we've done in the strategy team shows one of the biggest differences is actually the yield gap. So if you take the 10 biggest companies back in 2000 at the peak of the market, they had an earnings yield gap. So earnings yields relative to interest rates of minus 500 basis points. So interest rates were 5% above the earnings yield. Now that's the other way around. The earnings yield of the 10 biggest companies now globally, which is dominated obviously by what I call the US terror caps, the $1 trillion tech companies, that earnings yield gap is positive around 250 basis points. So there's a 750 basis point gap in this earnings yield gap, the cost or value of equity versus the cost or the value of interest rates. So I see echoes of the late 90s. We've got more retail investors in the US getting involved, the Robin Hooders, etc. Absolute valuations in some cases look quite scary, but we still see support here. And if we're going into a world of synchronized global growth next year, technology as the leaders in this cycle should continue to get support, but the leadership group probably broadens. So that's why I think it's 99 and not 2000. Liquidity remains a key dynamic. If central bankers are pulling liquidity out of the system, is a different story. I don't think that's going to happen anytime soon.
Yeah, that brings me to my next question, which is about inflation. We're seeing five-year inflation expectations actually rising, at least since March. But we don't see any movement when it comes to bond yields. Do you think this will remain the case because central banks are so active?
Yeah, I mean, it's a really good point. Everyone talks about the death of inflation. We've had sort of a 40 years of mega trend of disinflation and a 40 years of mega trend in the bond market, this incredible bull market. Our economists at Berenberg put a report out last week highlighting and suggesting that sort of 40-year disinflationary trend was at an end. And while there are still some sort of near-term risks, we think that there are some strong sort of reasons why we should support a new rising trend of inflation over the next sort of 10, 15 years. And sort of deglobalization is one of those risks. Aging societies is another. A weaker dollar obviously would help, and central banks are adjusting their inflation targeting, which should allow that to happen. So there seems to be this pivot. And as you say, five-year has already been picking up since March. And within the equity market, there has been this quiet inflation trade that has already been happening. And it's been happening in Europe. It's been happening in the US, slightly distorted by tech, but very broadly, defensives have lagged since around sort of April time, and cyclicals generally have led the way. The missing parts have been banks and energy, the value trade, which have continued to underperform. And I suspect that we need confirmation of, firstly, synchronized global growth, and secondly, a much stronger inflation pickup before those two sort of big former sectors, which have lagged over many years now, actually sort of join in as part of the leadership group. I'm not expecting that anytime soon.